And welcome back to another episode of Spark Your Fire. Hope you're having a lovely afternoon so far, and certainly John and I are. We are enjoying a bit of a soccer match discussion just before we come on air.
Yep.
John's been a big fan and following closely in terms of the soccer matches. I haven't, I gotta say. So, John, what's the latest goss, mate? What's how's the Australian team performing so
Oh,
far?
look, I'm a fair-weathered friend. I don't normally follow, but the World Cup, I'm all in. I am all in. Australia just drew with Paraguay. Like this is like 15 minutes ago, so our listeners can date stamp it. And the USA lost to Turkey in the last 2 minutes of the game. So that
There you
was yeah,
go.
3-2. So interesting. That'll all be public knowledge by the time this goes to air.
Yeah, anything can happen in the last minute, right? You can't let your guard down, basically. So.
Exactly.
Just
That's
when you
right.
thought the game is over, it might not be over as a matter of
Correct.
fact.
Yeah, yeah. Stakes are pretty high. So yes, I'm sure there's a real estate analogy in there somewhere for us.
100%,
You
mate.
know.
100%. 100%. So I think there's a lot of gloom and doom at the moment in terms of the
Mm,
property industry. I
correct.
won't deny, and I think everyone's fully aware of it. Subsequent to our budget conversation, plus the most recently, well, it's timestamp today, 26th of June, 2026. I think yesterday the Greens and the Labour have now passed the budget, the federal budget. It's now passed Senate, and it's now been passed back into House of Reps. Again, to get it ready to get it drafted up. So unfortunately, that's all done deal. SMSF, the
Yeah.
limited recourse borrowing. I think LRBA. Sorry, apologies about the lack of technical terms here. Basically, they're also banning borrowing under SMSF for resi properties as well, and that was the
Mm,
last straw which Green has requested in order for them to support passing of the federal budget
yeah.
across. So that's basically the last straw that killed the camel in terms of the resi property, because I know a lot of the buyers agents, not you, John, a lot of the other
That's
buyers
right.
agents were being pushing for SMSF ever since the negative
True.
gearing
Yeah,
stuff has
that's
been,
true.
yeah, so that's unfortunately kind of pushing them out too, just when they were
Yeah.
about to position themselves to help people with buying on the SMSF.
Yeah.
That door has now been closed too. Okay, so look, in short, a lot of doom and gloom, unfortunately, in the property industry, and that's why I think it's worth raising the question, John, for our discussion today. Is residential property still worth investing in 2026? Right? With all these negative news, we've had three interest rate rises since the start of 2026. We've had a negative gearing that's being scrapped, which impacted borrowing capacity, which impacted cash flow from holding perspective. We've had the CGT discount, 50% CGT discount being changed to an indexation method from 2027 onwards. And subsequently, well, not to mention the 30% trust distribution tax as well. I mean, that's also on the way, plus the latest SMSF bond for resi properties. So
Yeah.
everything is kind of being clamped down. And, like at the start of the year, everyone's perception is very different. It's going to be another great year for residential property in Australia. Right now, I think a lot of people's view have changed. So what do you think? Is it still a good time? Is 2026 still a good year to be investing in residential property, John?
So yeah, I mean, you covered a lot. I mean, and you're right. They went after self-managed super funds. That came out of the blue. Like my wife goes, "Oh, I knew they were going to do that," but I mean, it's
That was a
stunning
bit of a
every time
surprise.
something like this happens. And
Yeah.
there does seem to be a game of whack-a-mole by the Labor Party to kill the real estate market. So if people start buying properties in like PTY limited companies, they'll ban that too. It's like, we're trying to kill the patient here. So what do I think about whether it's still worth investing in property? And I guess the key word there is investing as well, like
Yes.
because it's always a good time to buy a property that you're going to live in because that's more of a stage of life question. Are you about to have kids? Are you getting married? So I guess we'll park owner occupiers. We're just talking about
Yeah.
investing.
Sure.
So there's this great, everyone thinks they know all the Warren Buffett quotes, but there is one that I came across the other day that I'd never heard before, which was that no one buys a farm because it's going to rain next year. You buy because you're going to make money out of it over the next 20 years. And that's how I feel about resi real estate. So resi real estate, a bit like a farm, produces or investing in residential real estate produces one of the most essential assets. I mean, essentially, it's food and shelter, right? So, and energy are the big things. And no matter what happens to society, we're going to need accommodation. Now, I guess the Labor Party are trying to turn accommodation to sort of definancialize accommodation so that it's no longer a like an investable asset, that it's just something that you buy like movie tickets or food or something. You need it to sustain life, but you don't. No one's profiting out of it. And the reason that's so boneheaded is because if you deprive something of investing, you get less of that thing. So the reason we have food is because someone has invested in a farm. And the reason we have oil at the pump is not because there's oil at the pump and that it magically appears. It's because someone has invested in an oil rig. And that was really risky. But we allowed the investment in the oil rig, and downstream from that decision, you get oil. And so if we block the investment part, downstream we'll get less of that thing. And what we're going to get less of is investment properties. But actually, it's even worse than that, because you're not just going to get fewer investment properties, you're just going to get fewer properties, because an investment property and a property that you live in is the same property. They're not advertised separately. Uh, so we're just going to get fewer properties. And the reason why I think that it is a good time, or at least it is still worth it, let's say, using that vocabulary, it's still worth buying real estate. As I said, it's essential. But two, we are sleepwalking into some serious shortages, right? So they've raised taxes on property investors, which is essentially what negative gearing does, and capital gains tax. And then they've gone after the investors. So fast forward 3 years, we're just going to have shortages. So I don't know the way the shortages will prevail, or the way they'll manifest, is firstly in higher rents. So that'll be the first thing. It was starting to. I'm getting mixed messages on whether the rents are starting to pop. I was speaking to a guy the other day who said they're pushing the rent ask, and they're getting the numbers. So maybe rents are already moving. But if you hold the beach ball under the water, eventually it's going to fling into the air, which is sort of what we're doing to the property market. So prices will explode. The question is when, and it's probably 3-4 years from now. But like, if you have to plant the seeds now so that you get this big spring in residential real estate values plus yield in 3-4 years' time, it makes a lot of sense. So do I think residential real estate is going to go up this year? No, it'll go down this year. It might even go down next year. But as rental pressures start to rise,
Good.
and as shortages start to appear, which is what happens when you cap prices, essentially that's what we're talking about. Matt, like, I don't know when, but in not the not too distant future, we're going to have that beach ball flinging into the air, which will be residential real estate prices. And it won't. It's because the tax treatment will create shortages, and shortages will create higher prices. And that's why I think, yeah, like, it's totally, as long as you're willing to not make money this year, maybe next year, the rewards are there. This is what we're doing, is essentially, this is 2008, 2009. That's what we're living through. And all the people complaining about housing affordability wish there were more 2008s. Well, here you go, right? So what are you waiting for? I would say go for it. I would say that we are sowing the seeds of structural supply destruction, and that structural supply destruction will be very beneficial to property investors within the next less than 5 years.
John, let me play devil's advocate here.
Yes.
If you're expecting that the prices are going to drop in the next year or two, or this year, next year,
Mm.
and I know that I'm going to be making losses this year if I go into the market and purchase something today, what's
Yeah.
stopping me from holding off and
Why don't you
then
wait?
purchase maybe towards next year?
Yeah.
It's like
So
catching a falling knife, if you know what I mean.
yeah. So I hear you, and I think there's a couple of ways to respond to that. So firstly, um, this concept of like waiting for the bottom, not only do you never know when that is, but actually, I'm only speculating it's going to keep going down, although I think it will. Um, the reason that you shouldn't wait too long for perfect timing is because you're getting older every day. The real estate market isn't getting older. Australia is fine, but you as an investor, you are getting older. You're, if you think of, you've got like 50 years of income earning years. And every year you wait, now you got 49 years, then you got 48 years, then you got 47, and so on, right? So if you're in the middle of your life, you can't afford to wait for the perfect time because you're going to have a loan to pay off. So that's the main reason why you wouldn't wait 2 years is because you'll be 2 years less attractive to the bank.
Mm.
Um, that's right. The other reason why is if you buy early enough, that is more rather than like buying one property at an amazing price, you might be able to buy three properties at a good price. So if you could stagger them, you might get this discount period for a bit longer when you can accumulate multiple properties. Maybe not at the bottom, but at least that would be more of a portfolio approach where you buy three really well-priced properties rather than one perfectly priced property. And that would be the other way I would look at this.
Okay. Okay.
Mm.
Interesting thought. Yeah, no, look, I think certainly from a timeline perspective, we talk about timing as opposed to time in the
Yes.
market.
Mm.
That's one of the things that a lot of people will say, well, I was like, well, hang on a sec, it's John, it's dropping this year. Like,
Yeah.
and if I buy next year, at least I would still I might be able to pay 5% less. So
Yep.
why am I going in 2026? Let me wait until 2027, see how the market goes,
Yeah.
and then go from there, right? But your counter argument there is basically you don't know when the bottom is. It might be bottoming out at the end of 2026, so it will be too
Correct.
late, and it could be rebounding in 2027.
Yeah. Yeah, yeah. I think the
Mm.
biggest moves in any sort of, there's the old saying that markets go up the stairs and down the lift,
Yeah.
right? So, so a lot of the big move happens early, right? And so
Yes.
property's probably gonna process the price correction this year, and then
Mm.
it's gonna muddle along for a couple of years with maybe
Okay.
some false starts. Like essentially in 2008, the market was flat between 2008 and 2012, but the declines happened in 2008.
Mm.
And then it went sideways for 4 years. So there won't be many years of declines. There'll be like 1 year of declines and then several years where it goes sideways and just digests the price decline. So that's why if prices, particularly at the upper quartile, are down, say 15%, and maybe they've got another 5 to 10% to go, the correction's sort of in, and all you would be is early for the upswing. So the upswing's certainly not in, but why not bank your deals sooner than later?
Yeah. And I guess the other thing is also
Mm.
at the moment, there would be a lot of people looking at selling as well to take advantage of, I guess, investors offloading their
Yep.
stock before until now, till pretty much 30th of June 2027, they still want to take advantage of 50% CGT discount before the indexation method kicks
Yeah.
in. So there could be a lot more stock available on the market from now till that period of time, which means they could give investors a little bit more opportunity
Yeah.
to be able to score something as long as the numbers still make sense and stacks up.
Yeah, the stock availability, I mean, you raised a really good point. What we saw in 2020 is that unlike the stock market, like where
Mm.
the units for sale are always fairly constant, the real estate is a bit different and the reason you and I picked the boom in COVID is because we saw supply constraints. So what happens in a real estate correction is that the people stop selling. That's sort of unique to real estate. So that's starting out. I'm speaking to real estate agents where they're saying listings are just being pulled
Yeah,
all the time. It's like very
yeah,
frustrating for them because that's their
definitely. Yeah,
crust. But from a buyer's perspective, supply is getting pulled off. Now, I think the data is suggesting that there's quite good supply at the moment, but I don't know how long that will last. I suspect that won't last very long. So if
yeah,
unless you're in distress, you're not selling. And if you're a discretionary seller, like you're trying to bank some profits or you're, trying to put, I don't know, there's all sorts of reasons. Only if selling right now is essential, would you sell right now? So I would expect to see supply to start to
to dry
constrain,
up. Yeah,
put a floor under the market. And haven't
yeah.
seen it just yet, but anecdotally, I'm hearing it.
Yeah, I mean the high interest rate certainly causing a bit of contribution to that, right?
Yeah.
Because making it harder for people to service their own mortgage as well as holding on to the investment property,
Mm,
especially with a portfolio. As such, some people might decide to go, I'll take the profit off the table, pay
Yeah.
off a little bit more debt, and then reassess and go from there. So, um, yeah,
Just a couple of other things that are sort of swimming about in my head as well. Like, I, I, I do feel that at the first hint of a rate cut,
mm,
there's going to be a lot of, I mean, I hate the expression pent up demand, but there will be a lot of sidelined investors who will be looking for the first like
yep,
green shoots.
yep,
Um, the oil prices, like a month ago, it was like $95 a barrel US. Now it dipped under $70 last night. So it's about $70. It might, $69 yesterday, and it's bouncing around at this stage. What that means is that all of the inflation expectations are going to start to decline. The 10-year yield, the 2-year yield, these yields are all crashing, which is suggesting that they expect rates to start coming down, but they also expect future GDP growth to be lower.
be
My
lower.
point is that inflation pressures are coming out of the market, and I wouldn't be surprised if the chatter, and also Australia's clearly in a recession. And so I wouldn't be surprised if the chatter grows about a rate cut. Now we start to get rate cuts, and what that it does a couple of things. It'll spur demand, lending serviceability will go up and all those sorts of things. But what it
Yes,
will also do is it'll like negative gearing is only a problem when interest rates are high and you've got something to claim. When interest rates are low, no one talks about negative gearing because there's nothing to claim, right? So your biggest expense no longer exists.
yes,
So when rates start to drop, the effect of the negative gearing changes will become irrelevant. And so I
yep.
think that we're off to the markets now, off to the races. Now, I don't think that's this year. I think that there'll be a recession declared this year, but I think rates might start to come down very late this year, probably early next year, and then we'll see that'll take the market into a new place.
Depending on how the trim mean goes in terms of inflation, I think the May data was still showing a trim mean of about 3.4.
Yeah,
It's actually gone up. It's actually
it
gone
went up.
up,
Yeah,
whereas the headline inflation went down. But because it was mainly because of the petrol subsidy, I suppose
correct.
that was still in place, right?
Yeah,
But yeah, certainly that plays a big part. I think that hopefully with the Middle East situation now being stabilized, even though I think that it keeps on changing daily at the moment, no
yeah,
one tracks
yeah,
it. Hopefully that gets stabilized, and then we will be able to see the real problem at the moment probably still lies within Australia in terms of inflation.
yeah.
It's easy for our treasurer, Jim Chalmers, to kind of paint the picture to say, hey, it was all caused by the Middle East situation. That's what,
Of course.
petrol prices and everything, that's what's causing the high inflation.
Yep.
But RBA Governor Michelle Block has been very clear from day dot. The inflation is our own problem, even
Yep.
before this Persian war crisis started, right? So once that's kind of settled down, I think we will get a clear picture. The main thing could be just the unemployment. If the unemployment starts tracking up, people won't be able to afford their mortgages. There will be probably RBA will have to respond
Yep.
quicker in terms of having to drop rates and
Correct.
that kind of stuff. But like you said, I think the GDP at the moment or the economic forecast growth isn't as stellar as how they look.
Yeah.
And it has been a while too, by the way. I think it keeps on getting corrections, keep on getting adjusted downwards in terms
Yeah.
of that side of things. So that's certainly not looking good. Um, but yeah, look, coming back to this, I think all of this has an impact on, I guess, the sentiment of investing as well. Because right now, the
Mm,
investing sentiment is kind of at a historical low. Like, is it a good
mm,
time to be investing? Well, probably not. But if we look at it from a opportunity angle, which
yeah.
is basically what you're saying, there are still deals that can be found, but it might just not be your resi bread and butter, and certainly not in the higher end side of purchase
Yeah.
prices, I suspect. I mean, those are the ones, the higher purchase price ones are the ones that's basically dropping fast at the moment because there's no demand
Mm,
for them anymore due to no net gearing. But anecdotally, I think anything below 1 mil, that's where majority of the first-time buyers and the investors are now competing against each other because that's their
yeah.
affordability range. So as a matter of
Yeah.
fact, anything between the 500 to 1 mil, I reckon will still perform fairly well in the next 6 to 12
Yeah.
months. Whereas anything above 1 to 2 will be struggling to sell. Anything above two, it has to be heavily discounted
Mm,
in order to get buyers or upgraders to be able to lure them in.
yeah.
So In the short term, there's lots of headwinds at the moment. Is it a good time to invest in 2026? I think really depends. If you got the financial capability, if you
Yeah.
are able to take some risk, I think in the long run, John, like you said, that's going to reap the reward. But we're not expecting to be like the days where you can just shut your eyes and buy any property in Australia,
Yeah.
expect it to grow is gone, is way behind us now. You need to be
Mm.
very, very selective. You need to have a strategy behind you to be able to how to work it because at the moment, any losses against the property, it's going to have to come out of your own pocket.
Yes.
Not many people with the current high rates, high interest rates, high costs of inflation, not many people can afford to fork out 5,000, 10,000, or even more per year from their own pocket to be able to hold on to
Correct.
a loss incurring property. Let's put
Yeah.
it that way. So
Hmm.
that's what's driving people off from investing.
Yeah.
I think that's from a short-term perspective. But having said that, we're still in the inflationary economy. So, the construction costs and the material costs continues to go up at this stage, which means the new build's going to get more and more expensive.
Yep.
And even with this latest round of federal budget, they're pushing investors to look at new builds because that's their way to try to incentivize more supply into the
Yes.
market, essentially, right? So that means there's going to be more demand. The investors going to be more investors looking at new builds, which means the new builds are going to get more expensive. And the gap between the new build properties and the existing properties, which no one's really looking at, or not many people are looking at much now, that's going to widen in maybe in the next 3 to 5 years,
Yeah.
essentially.
But
All
the
right.
problem is the people who buy new properties will they will buy a new property, but the
Hmm.
moment they buy it, it becomes an old property. So they'll have no one to
Correct.
sell it to. And that's
Correct.
and so they'll never get their
Yes.
money back. So all these people, it's a poison chalice. They're buying a kind of a whatever poison chalice. And so they're going to buy these unsellable new
Hmm.
properties.
Hmm. The
This
only
is
way
it's
to
bad
the only
policy,
way
all of this. Mm.
Oh, I agree. And the only way to look at the only way that would make sense is you're looking at a very, very high, very long-term horizon, maybe not even
Yeah.
selling at all, right?
Correct.
If you're able to hold on to it, it's going to give you negative gearing because new
Mm.
builds does get negative gearing. You can enjoy the 50% CGT tax
Yeah.
discount when you sell as well, if you choose to, right? That's when you sell. But if you hold it 10, 20 years, the property is going to be positive and hopefully your debt
Yeah.
will be very minimal at that point. So that way you don't have to sell. I think that's the government's thinking behind this to be able to do it, right? To
Yeah.
create more supply on that.
But we've created all these constituents who don't want to sell. So if you,
Mm,
if you bought a property before budget night and you've got
yeah,
negative gearing, which we all know are not benefits, but and you get to claim deductibility for your losses, you're not selling because you lose it the minute you
correct.
sell.
That's
Then
right.
if you're a new buyer and you go out and purchase a new property and you get all these so-called concessions, you're not selling either. So
Mm,
where
mm.
does the new so does all of the new supply come from builders? Like the rest of the so all these cherry-picked constituents are no longer going to be selling their properties. I mean,
Yeah.
this is potentially a massive disaster.
It could
Um,
be. It could
yeah,
be correct, and that's what could be causing, like the next wave of
yeah,
issues when who knows what's going to happen down the road, right? When no one wants to sell because everyone's got reasons not to sell,
yeah,
and they're just going to hold on to the property
yeah.
indefinitely. Let's put it that way. So it actually benefits from a long-term perspective, right?
Mm,
But because it builds in that mindset of you should be keeping this investment long term as opposed to short term trading slash
yep.
flipping for profit, which I totally agree with because that's pretty much our philosophy as well. But then the issue then comes down to okay, well if nobody sells, then where are the new stock going to be coming
Yeah.
from? How could the first home buyers afford to actually purchase anything if there's nothing to buy, right? So exaggerating a little bit here, but that's essentially the
Mm,
the idea. But yeah, and I look at it from, I guess, is residential investment property still worth investing? Looking at it from a short term, mid term, longer term perspective. Short term, 1 to 3 years, mid term, 3 to 5, maybe longer term, 10 plus years. In the short term, we're pretty much covered it in a very detail at the moment. There's lots of headwinds at the moment. Don't expect prices to go up. Okay, well, that's going to drive a lot of people not
mm,
investing. That's fine. But people who can take and capitalize on this opportunity will. Midterm, I think the way how, based on our projection, the rent's going to continue to catch up. which means, and along with the price pulls back, or depending on the price bracket, but at some point in time, the yield's going to stack up again for existing property.
Yeah. Yeah. Yeah.
And when the interest rate in that time, because economic is probably not going to go through, the GDP is not going to be too great in the next couple of years, in the midterm, probably, interest rate's going to have to come down, which means all of a sudden, existing property becomes viable again as an
Yeah.
investment.
Yep.
Because you could be holding on to property that's neutral, not having you to fork out too much of the money. In fact, some of them might even be able to go positive, right? So from a midterm,
These tax changes are actually the distortion. The negative gearing was not a distortion. It just, add up your income, apply the tax
yep.
rates. And what they've done by stopping that, or I mean, technically they're allowing you to carry it forward, but now they're treating like income expense like a capital loss. So it's a strange old proposal that's going to go through. Um, but they're taking this low risk asset and making it high yield, which is going to be really, and that's why, like, fast forward 3 years,
Mm,
residential real estate is going to be seen as very compelling because it'll be a high yield, low risk asset, which is always the inverse of what it should be. Low risk assets should be low yield, and high risk assets should be high yield. And they're going to make residential real estate cash flow positive from day one, which will be strange, and it'll be the opposite of what they're trying to achieve.
but that has happened before as well. Remember the days when Western Sydney houses were selling
Yeah,
for what, $300,000 and they were renting for
yeah,
about $300, $400 a week. That
yeah.
type of yield is what we have gone through before. This whole
Yes, that's
super
true.
cycle has gone through,
But
right? So
that's
it's just
right.
repeats itself.
Cycles, the free market did that, right?
Yeah.
It created places of like overvaluation, other places of undervaluation, and the market's clever. It goes to where there's undervaluation. That you didn't need to kill the patient to like construct a cycle that allowed people to buy. And what's interesting is this could potentially be the worst time to have ever done this because I mean, the cycle work that you and I have done, I mean, some of our listeners will know about the 18-year cycle. The 18-year cycle was suggested that 2026 was always going to be a bad year. And so maybe like they sort of poured kerosene on the fire and exactly the time they didn't like the prices were always probably going to correct this year because they were correcting before budget night,
Mhm.
correcting from about December. So maybe the market was already going to do that elegant thing that markets do, as in sort of rein in prices. And what they decided to do was throw a grenade into the furnace anyway. It's like
Exactly,
didn't
exactly.
need to do
Just
it.
exacerbate in terms of the
Yeah.
reduction in terms of the prices and yeah, anyway, but and then in the midterm as well, I mean in 2028, all Australians will be up for re-election again. Who knows what's going to happen
Yeah.
out of that? If there is a change of government, potentially, I'm saying potentially, although personally I think it's unlikely, there
Mm.
could be some changes to the tax reforms that we've just had this year as well. In other words, CGT discount changes might change. Um, Very slim chance of reintroducing the negative gearing again, although personally, I think. But it'd be nice if it does. But yeah, I suspect as a property investor, I think we need to work off based on the current situation. In other words, CGT indexation method continues to be the norm. No negative gearing being reduced back. This will be the new norm moving forward, and then
Yeah.
plan your investment journey from here. So I think that's the midterm view at the moment
Mm.
in terms of like 5 years. You look like
Yeah,
you're
I
going to
think I
say
think you're
something, John.
right. I think you're right to point to like the political pendulum that will
Mm,
swing. Elections will be won and lost, and I do think that they will bring back negative gearing. They just won't call it negative gearing. So it'll be like, are you able to claim
depending on whatever.
like interest against your POIG tax? Yes, which is which is negative gearing. So uh, that they won't call it that though, because I think it was too much of a kind of a hot potato. But they will bring back they'll kind of even or normalize deductibility rules, right? So or
Mm,
universalize
mm,
deductibility rules rather than saying you can do it but you can't.
mm.
Um, and it also makes me think about like if you zoom out and I like that you talked about like short term, medium term, long term. Like are we long term investors? If yes, then nothing to worry about. And are you short term investors? Well, then you might have to like fine tune your timing a little bit. But you know, if when has buying land ever been a problem? I mean, when has buying accommodation ever been like a bad idea? Like we have market corrections every couple of years, and there's always a bias towards inflation and higher prices, and either the rents are going up or the prices are going up. And I think that you know if there were bubbles in the 50s, there were bubbles in the 60s, and I would love to have bought in the 50s and 60s. I wasn't alive then, but my point is that real estate's been, particularly residential real estate's been a pretty good investment for approximately the last 250 years.
Yeah.
So I do expect that to continue to be the same. And when you look at charts of, do you remember back in 2026 when there was that correction? I think that it'll look like a little dot on the long-term chart. We'll see.
Yeah. And I think the main thing why resi property, I guess, still has its place is because at the moment, I think none of the government is looking at addressing the supply issue at all. They're not.
Yeah,
They're
yeah,
not.
that's right. Yes.
That's the main crux of it. That's why in the last 20 years has performed so stellar because that hole, that supply slash demand hole has just become bigger and bigger as we go each year.
Yeah.
Labor just keeps on importing more migrants across, right? But they're not building enough to be able to match that. So unless the migrant tap has been turned off or heavily
Correct.
reduced, otherwise this situation is not going to change, basically. There's always going to
Yeah.
be more demand. There's always going to be people needing shelter, and therefore we're not building enough. I'm sorry, there's always going to be competition, and that's going to put the
Yeah.
upward price pressure, essentially.
You were so right that then that they never addressed the demand
Yes,
at its core, which is migration, and so we always talk about residential real estate as though we have a supply problem. It's like building a lot of houses. I wouldn't, it, but they will never say we should cut migration, and I don't understand why
mm,
it's this untouchable third rail. Of course, like that would solve the solve the problem, and it would. I mean, we're seeing this in Canada. In Canada, they've slashed immigration levels and rents are coming down. It's like, okay, well, here we go. Problem solved. This has always been a man-made problem, which means
yeah,
it's a man-made solution. And it's funny that it's this untouchable, unsayable thing.
mm.
But yeah, just rein in the immigration numbers. I mean, it's very hard to build one Canberra every year. But that is what is required at these immigration level, more than one Canberra. So
As soon as they do
um,
that, the economic numbers are going to go down significantly, right?
that
Like
is
they're
true.
able to maintain just a slightly positive GDP at the moment, thanks to
Yeah.
those migration. As soon as they cut that, mate,
Yeah.
it's going to look ugly. And then all of a sudden they go, well, Labour, you guys are terrible money managers.
Yep.
What have you done,
Yeah.
right?
Oh, no, 100%. Like if our population is growing at 1.5% and it's not birth rates, then there's your GDP growth, 1.5%. And
Mhm.
even if we're getting poorer by person, let's say we get positive GDP of 0.5%, based on 1.5% population growth, it's like politically that's problem solved, but on the ground it's a major problem. So what happens if you don't stop all the people coming in and you can't build enough properties? Well, it's like shaking up a bottle of Coke but never unscrewing the lid, right? But
That's right.
eventually it has to blow. That's the thing. We talked about I always have these silly analogies, but the beach ball held under the water. Like eventually it's going to fling up. And
Yeah,
and the only reason I say that is because they've never stopped the currency creation and the immigration. And
yeah.
eventually it's just a matter of time. And it
Immigration.
won't go up gently, it'll go up violently. So there'll be
Mm,
there'll be a year when real estate goes up by, in Sydney, goes up by like 15%.
yeah,
And then it'll keep going. The demand and the supply factors haven't changed. It's
haven't
just
changed
yeah, they've just
fundamentally.
screwed the cap tighter on the Coke bottle, and it's just going to defer the problem.
That's right. That's right. So yeah, so that's why I think in the long term, that's still why the resi property still definitely has its own place. Like you mentioned,
Yeah.
the inflationary nature of our currency just continues means that, money keeps on devaluing itself. So in the long run, that's still one of the best way to be able to preserve your wealth in the long run.
Yeah.
That probably doesn't change, even though a lot less people are looking at it that way now. But fundamentally, that hasn't changed at all, right? And supply demand issue, unless something significantly going to change from the migration perspective or supply side of things. Um, don't forget how much red tape they have to go through for developers to be able to build at the
Yeah.
moment, right?
It's
So
tough.
it's a bit of a joke at the moment, but anyway, so that's not being solved, which means they're not building enough. So, like fundamentally, it's still going to be something that's, like you said, free market's going to make it make resi property viable again, maybe even in the midterm. We don't even need to look at 10
Yep.
plus years. That's probably going to turn quickly, and that's going to turn, and as soon as people realize that, that's going to be the next run again for
Yeah,
this.
yeah, yeah, that's right. So yeah, and just to, from my perspective, at least, to put a ribbon on this,
Mm,
like if governments come in and like skew the risk profile of an asset, right? So they say,
yeah.
okay, like landlords versus tenants, right? There's always been this sort of tug of war
Yes.
between, which way the pendulum swings. So when the pendulum swings towards tenant rights, and you put all the risks on the landlord, which is what I would arguably say is happening now. So you can never kick a tenant out. They can have the pets. They can do whatever they want. They don't, or when the risks go towards the landlord, the market has this elegant mechanism to reward the people for taking risks, and so rents go up. Rents go up when the risk reward profile becomes so out of whack. Now, the way to bring rents down would be to de-risk landlords, but no one would do that because it looks like you're not protecting the little guy. So the little kind of payback is that the rents have to go up when you do that. Likewise, at the level of buying property, if you make it so risky to buy residential real estate, you will eventually get rewarded. The market has this elegant way of pushing yield back towards you, and that's what's going to happen.
Summary. Well, thanks for that little ribbon to tie it up. But I think we can all agree. I mean, it's still a viable investment asset, but it just comes down to people's appetite, risk appetite, and financial situation to see whether it's worthwhile investing. And as we always harp on, the if you look at it from a long-term perspective, this hasn't changed anything.
Correct.
This federal budget, these changes have not changed anything from the resi property investment perspective. So, if you think of it from that perspective, then it's business as usual.
Yeah. The deals are on at the moment, so business as usual, but it's very, very much in favor of the buyers.
That's it. That's it. And that's the main thing. It's in favor of the buyers. So if you are looking to purchase at the moment, you've got a lot less competition. Not to mention, like, that's very different to what in 12 months ago, during this
Correct.
time last year. Very, very different. So anyway, I think that's a good summary and a good discussion, a good bit of a good discussion there, John. I think, as always, you come up with some brilliant ideas. Love that beach ball. I think always the pressure cooker analogy is probably the one, and it keeps on building up and
Yeah.
then it eventually blows up. But anyway, good analogy there.
Yeah.
So, all good. All right. Well, let's call it a wrap. Yeah, I guess to our listeners, thank you for joining us, and hope you like the content. If you got any questions, feel free to run it past us. Obviously, got our emails down there. And as always, consider investing in the long run. Hopefully, this episode has proven a bit of insight and hopefully changed some people's mind in terms of investing in real estate or resi real estate in Australia. But until next time, we'll chat to you again, John and David.